Have you ever thought that you could make a profit in the world of trading in just a few days or weeks without having to sit in front of charts for months? Imagine each trade is a small mission with the goal of entering quickly, taking profits, and exiting. This is the real power of swing trading, a strategy that relies on discipline, discretion, and perfect timing. But if used correctly, a normal person can become extraordinary. Chapter 1. The first step in swing trading is to sharpen the mind. Many people consider the stock market to be a gamble or a long-term investment game, but swing trading is different from both. It's a method where you can quickly grow your money in a few days or weeks by catching a trend and momentum. It's not a marathon or a 100-meter dash. Rather, it's a mind game where the right decision is made at the right time. But it begins where every good trader starts, with oneself. The author first explains that the most important thing is to know your own personality. Are you patient? Do you have the ability to control your emotions? Do you believe in discipline? You have to ask yourself these questions because swing trading attracts money. The real focus of swing trading is capital preservation, which means saving your money and then growing it. Many new traders come in thinking they only want big profits, but the author clearly states that if you lose your capital at the beginning, the road ahead will be very difficult. So, first learn to catch a trend and then think about the exit. The author says that a swing trader's mind should be like a strategic general. When a trend starts, whether up or down, it becomes an opportunity. Technical analysis is essential to recognize that opportunity. Swing trading is not a game based on guesswork. It's based on chart patterns, indicators, and volume analysis. But all these tools will only work when your mind is focused and your plan is clear. Now let's understand how money is made in the market. The author says that money is made when you think differently from the crowd. When others are afraid, you see potential. When others are trading out of greed, you think with logic. This is mental discipline, and this is the strength of a swing trader. This doesn't mean you have to sit in front of the computer all the time. The beauty of swing trading is that you can get good returns by analyzing for a few hours a day and making only a few trades a week. You just have to set up a system, such as creating a watch list, determining entry and exit levels, and then, when the signal is received, taking action without hesitation. But the most important thing is risk management. The author explains very practically here how to control risk with each trade. For example, never risk more than a small part of your total capital, usually no more than 1 or 2%, and set a stop loss on every trade. These small things help you stay in trading for a long time. It's normal to have losses in trading, but it's your responsibility to keep them small.
Now we are talking about how important a clear trading plan is for any swing trader. The author says that trading without a plan is like traveling without a map. Your trading plan should include the conditions under which you will enter, the level at which you will exit, how much quantity you will take, and what the risk will be. When everything goes according to the plan, emotions work less and logic works more. Now let's talk about the time frame, which chart to look at. In swing trading, the daily chart is generally considered the most suitable because it allows you to see the bigger picture. With this, you can also see the support and resistance levels well. The author says that chart patterns like flags, pennants, and head and shoulders can open your eyes if you learn to read them correctly. Another important point the author teaches us is the market doesn't care about your feelings. This means that if you have invested money in a stock, don't hold it just because you hope it will go up. You have to look at the stock's performance with a cool head. If it hits your set stop loss, exit without emotion. This is the real lesson of professional trading. Besides this, the author also explains that a good swing trader always keeps a journal. You record every trade, why you took it, when you took it, what you thought, what happened. This journal is your biggest teacher. It's a kind of personal mentor that helps you improve over time. The summary of the first chapter is that swing trading is not just a strategy, it's a way of thinking, a mindset, a process. If you want to see the market as a playground where you can play with control, then swing trading is the right path for you. But for this, you need to understand yourself, create rules, control emotions, and move forward with an ironclad discipline. And most importantly, keep learning, because in swing trading, every day, every trade, and every chart brings a new lesson, and the one who is not afraid to learn moves forward. Chapter 2. Building a trading system. No matter how confident you are, until you build the right trading system, every step you take is at risk. To be a good trader, it's not just important to understand the market, but also to know yourself thoroughly, and to convert that understanding into a system. This second chapter teaches us just that, how to create a successful swing trading system that will help you with every trade. First, the heart of every system is its edge, that advantage that puts you a little ahead of the market. Millions of people are trading in the market, but if you have a method that allows you to repeatedly seize good opportunities, that's your edge. This edge can come from your technical setup, your indicator combination, your time frame, or your discipline. But having an edge is essential. Otherwise, you're just flipping a coin.
The author says that when creating a trading system, 3 things must be decided first: your entry strategy, your exit strategy, and your risk management. If these 3 are not clear, a system is not built. Only a guess is made, which is not reliable. Now let's talk about the entry strategy. The author says that a strong entry happens only when 4 conditions are met. The trend is clear, the volume supports it, the price action confirms it, and your indicator gives a trigger. For example, if a stock is going above the 50-day moving average, there is a spike in volume, and the RSI is moving up, then it can be a potential swing trade. But you have to wait before entering so that everything is confirmed together. Another method is breakout trading. When a stock breaks an old resistance level, the breakout works only when the volume is strong and the breakout is clear. If it is a fake out, a false breakout, you can fall into a trap. So before entering, read the chart well and definitely understand the previous price behavior. Now let's come to the exit strategy, which often causes the most trouble for traders. The author says, bad exits ruin good trades, which means that if you exit at the wrong time, the whole profit can be lost. Therefore, it is important to adopt a structured approach. You can determine the exit in 3 ways. First, a predefined target price. Second, a trailing stop loss, with which you secure your profit. And third, technical signals, such as a reversal in RSI or a crossover in MACD. The most important aspect of an exit is to avoid greed. When a trade goes in your favor, most people think, I'll wait a little longer, maybe there will be more profit. But this greed is what traps you. The author says that if you have already decided on the profit amount, follow it. And if you want to follow the trend, you must put a trailing stop loss. These are small but powerful steps. Now comes risk management, which is the real guardian of trading. If you can control the risk, the other things can be learned slowly. The author's advice is never risk more than 2% of your capital on a single trade. This means that if you have 100,000 rupees, you should not lose more than 2,000 rupees on any single trade. Doing this will allow you to trade continuously without fear. Another aspect of risk management is position sizing, which means that you have to decide how many shares to take in a trade. There is a simple formula for this. Position size equals maximum risk per trade divided by entry price minus stop loss price. With this formula, you can make the right size decision in every trade, which will keep your risk under control. The author also says that many people are so afraid of risk that they don't even take a trade, but this is also a mistake. If you set the right risk, then look at every trade as a business decision, not an emotional gamble. Trading is a profession, and risk is a part of it. Manage it intelligently, not out of fear. Now let's talk about backtesting, which is the real test of your system. When you create a trading system, it is important to test it on historical data. This way, you will know how that system has performed before. You can go to your charting software and apply your system to old charts to see which trades were right and which were not. From backtesting, you will also understand how often your system works. That is, what its win rate is, what the average profit is,
what the average loss is, and what the max drawdown is. All this information helps you make a decision and shows whether your system looks good or is actually good.
After backtesting comes paper trading, which is trading in the live market without real money just for practice. This is a great way to improve your live market skills. In it, you can feel the market's movement, but without capital risk. The author advises that every new system should be paper traded for at least a few weeks so that you gain confidence in your decisions. And finally, a time for changes in the trading system also comes. No system is permanent. Markets change, volatility comes, and some patterns stop working. So it is important to review your system from time to time. But remember, changing the system every time something goes wrong is also not right. Give a good system time, analyze it, and then change it if needed. The summary of this chapter is that if you have a strong, well-tested, disciplined trading system, you will be able to survive in any market situation. This system is your guide, your shield, and your strongest companion. In swing trading, emotions can influence you very quickly, but when you have a clear system, you work with logic, not emotion. This is the difference between professionals and beginners. Chapter 3. Stock Selection. When you try to catch a trending stock, you have an opportunity in your hand. Either you will catch it in time and make a profit, or you will lose it and regret it later. In the third chapter, the author teaches the strategy to understand this opportunity and to make the most of it. That is, how to choose the right stock in swing trading. Because not every stock is worth trading, and not every movement is for you. First, understand that the stock selection process does not run on tips or news. You need a structured scanning system that will show you every day the stocks that might have a good movement in the coming days. The author says that for this, you have to decide on some special criteria, such as volume, volatility, trend, and the presence of a setup. That is, you give priority to those stocks that can move quickly but look technically clear. The author shares a very effective method, which is called the top-down approach. This means that you first look at the entire market, like the direction of the Nifty or the S&P 500. If the index is going up, focus on the long side. If the index is down, look at the short side. After this, you scan the sectors. Which sector is strong, which is weak. And finally, you focus on the best-looking stocks in that sector. For example, if the banking sector is strong and stocks like ICICI Bank or Axis Bank are trading above the 50-day EMA, are close to a breakout, and the volume is also good, then these can be good candidates for swing trading. The author also says that in swing trading, volatility is both a friend and an enemy. If a stock moves very little, there is no opportunity for a swing in it. And if it is too volatile, the stop loss can be hit repeatedly. The solution to this is to use an indicator like the average true range, or ATR, which tells you how much a stock moves on average every day. Now let's come to which technical factors are most helpful in stock selection. First, trend clarity. The author says, trade in the direction of strength. That is, choose stocks that are in a clear trend, up or down. Second, a clean chart. That is, a stock that does not have too much clutter or irregular movement. Third, it is close to support or resistance so that you can get a quick move after entry. And fourth, indicators such as RSI, MACD, or moving averages that provide a certainty to your decisions.
The most important advice is to limit your watch list to 10 to 20 stocks. If you have 50 stocks every day, you will get confused. It is more important that you deeply understand those few stocks every day, know their behavior, feel their movements, and gradually gain expertise in them. Now let's talk about stock scanners, which can make your selection easier. Nowadays, many online platforms such as TradingView, Charting, or Screener.in have free and paid scanners where you can set your conditions such as being above the 50-day EMA, RSI being above 60, volume being more than average, etc. You can create a scanner according to your needs and get a list of those stocks every day that match your setup. But technical data alone is not enough. The author says that you should also understand the story behind these stocks a little. That is the company in the news because of an event? Is there any result, merger, or sector regulation coming in the future? If yes, has the market already reacted to it? Knowing these things can save you from falling into a news trap. Another important thing is liquidity. The author clearly says not to trade in stocks where the volume is low, because both entry and exit will be difficult there. When you trade in a stock that is being traded in good volume every day, the spread is low, there is no slippage, and the trending movement is more reliable. Now comes a very interesting principle, relative strength. That is, choosing a stock that is performing better than its sector or the market. For example, if the market is going down, but a stock is stable or slightly up, there may be hidden strength in it. The author says that these stocks run even more when the market is good. There is a great opportunity for swing trading in such stocks. Then comes the behavior of the stock, that is, how it moves. Some stocks move in flag patterns, some are breakout-based, and some are highly volatile. As you look at their charts, you start to learn for yourself which stock is of which type, and then you can create your trading strategy accordingly. The most important message of this chapter is, don't trade everything, trade the best. A lot of stocks move every day, but only a few of them have a clear setup, a strong trend, and good liquidity, making them suitable for swing trading. If you focus only on them, your work will be both easier and more successful. So next time you sit down to trade, first follow your stock selection process. Create your watch list, filter it with a scanner, look at the charts carefully, and then choose only from those that truly show a trending, strong, and clear trade setup. Remember, money is not in the trade you took, but in the trade you chose thoughtfully. Chapter 4. Entry and Exit Strategy. In swing trading, just knowing which stock to take is not enough. The real game begins when you know when to enter and when to exit that stock. In the 4th chapter, the author focuses on this subject, that is, how to set the entry and exit strategies professionally so that every trade becomes a well-planned decision, not an emotional reaction. First of all, let's talk about entry. A good swing trader never jumps into a trade just because he feels the stock will go up. The author says that entry should be made only when your setup has become fully active. That is, all the conditions you have already decided on, such as a trend line break, a moving average crossover, an RSI breakout, or a special price action pattern, are all visible together. Here, the author gives a very practical mantra. Entry should be boring, not exciting. That is, if your entry makes you excited, it's probably running on emotion, not logic. A strong entry is like a surgeon who performs a surgery without making any noise, calm, professional, and certain.
In swing trading, there are two main entry strategies, breakout entry and pullback entry. A breakout entry happens when a stock breaks a resistance level, such as a triangle, a range, or an old high. But the author warns that not every breakout is true. There's always a risk of fakeouts, so volume support is very important with breakouts. If the volume is also increasing rapidly, the breakout can be trusted. On the other hand, a pullback entry is a little quieter but reliable. It happens when a stock is already in a trend and then it comes down a little, which is profit booking, or a short-term correction, and then prepares to go up again. The author calls this buying the dip in a strong trend. For this, you have to take the help of tools like support levels, Fibonacci retracements, or the 20-day moving average. Now let's talk about the exit. And in this, there are two types of exits. The first is a profit booking exit, and the second is a stop-loss exit. For profit booking, it is most important that you have already set your target. For example, if your trade is based on a 1-to-2 risk-reward ratio, and you've risked 500 rupees, then the target should be at least 8,000 rupees. When the price reaches that level, you have to exit without hesitation. If you wait in the hope of more profit, the profit often goes away. Second exit is stop loss. The author calls it a safety net, which saves you from a big loss. When your trade touches the level you yourself had decided that if it comes to this point, the trade will be considered a failure, you have to exit without any emotion. It's not easy, but it's essential. Besides this, there's a tool called trailing stop loss. It is an excellent way to increase profit and protect it at the same time. For example, you took an entry at 200 rupees, the stop loss was at 180 rupees. When the stock went to 220 rupees, you can move the stop loss to 200 rupees. Then, when it goes to 250 rupees, you can move the stop loss to 220 rupees. In this way, if the stock suddenly goes in the opposite direction, you can at least secure some profit. The author also teaches that in swing trading, it is not always necessary to put all your money in the market. Sometimes exiting a part of your position is also a smart move. For example, selling 25% of the quantity at the target and letting the remaining 75% run with a trailing stop. This allows you to book profit and also take advantage of the trend. Now let's talk about some signals that indicate it's time to exit a trade, even if the target has not been met. For example, if the price suddenly breaks the support, volume decreases, or your indicators like MACD or RSI start giving negative signals. Ignoring these signals can be costly. Another important piece of advice is never turn a trade into an investment. The author clearly states that if a trade is going against you, you should not decide to hold it for a long time. Swing trading is a short-term strategy. Discipline is the biggest weapon here. The biggest lesson of this chapter is that entry gives you an opportunity, but the exit tells how well you have used that opportunity. And the connection between the two is discipline. When you see every trade as a business transaction where both profit and loss are possibilities, but every decision is taken thoughtfully, then you start moving forward in trading.
Chapter 5. The biggest enemy in swing trading is not a bad indicator or wrong chart setup, but the human mind itself. In the 5th chapter, the author focuses on this most invisible but most powerful aspect, trading psychology. If you can control your mind, you will be able to think with a cool head no matter how fast or slow the market is. But if you don't have control over your mind, even the best trading system won't be able to save you. The author begins the chapter with a simple truth. That is, losses happen not because you saw the wrong chart, but because you made decisions out of fear or greed. Therefore, swing trading is not just a game of skill, but also of self-control. First, let's talk about greed. When a trade goes in your favor and you are in profit, the mind often says, let's stay a little longer, maybe it'll double. But this is where the downfall begins. You forget the target you had set in advance, and then the market suddenly reverses, the profit flies away, and you are left with nothing. The author says greed makes you stay too long, and the market punishes overstaying guests. There is only one solution to this: stick to the plan. Take the profit when it's visible and move on. Now, the second emotion, fear. It is the feeling that prevents you from entering a correct trade or cuts a good trade halfway through. Often, when the market is a little volatile, people get scared. When the trade comes down a few points, they sell it, and later that stock goes up. Fear moves you away from discipline. The author calls it fear of loss, which often causes a bigger loss than the loss itself. To escape this, it is important to set a stop loss and trust it. Give the trade some room. Getting scared at every slight movement is not a professional approach. The third emotion is hope. When a trade is going in the wrong direction, instead of closing it, we start thinking, maybe it will turn around again. And this thought turns a trade into an investment, not a trade. The author calls this situation a hope trap. There is only one cure for it: to act with logic. If a trade has gone below your stop loss, exit without any emotion. Now, a very serious problem: revenge trading. When a trade results in a loss, many people immediately take another trade just with the intention of recovering the previous loss. But this emotion doubles the loss. The author clearly says markets don't owe you anything. That is, the market will neither give you back your loss nor apologize to you.
So see every trade as a new opportunity, not as a revenge for a previous mistake. The most powerful way to control these emotions is to create a trading journal. Write down the details of the trade you took every day, why you took it, what was the thought process, where you entered, what were the stop loss and target, and what happened. This will help you understand your emotional patterns. You will see for yourself when you abandoned discipline, when you exited out of fear, and when you fell into greed.
The author says another great thing. Consistency is not about winning all the time. It's about following your rules all the time. That is, consistency does not mean that you will profit every time, but that you will stick to your rules every time. When you look back after 100 trades, you will see that you acted with logic most of the time, not with emotion. In today's world, where there is an abundance of social media, tips, news, and YouTube, it is very difficult for a trader to stay focused. However, the author suggests that while trading, you should maintain a calm and clean environment, create a disciplined routine, review your watch list before the market opens in the morning, fix the entry and exit points, and then just follow your plan during the live market. Do not look at any new stock or hot tip that day. Keep your focus only on what you have already decided. Another important thing is, never link your personal worth to your profit or loss in trading. If there is a loss one day, it doesn't mean you're a bad trader. And if there is a profit, it doesn't mean you have become a god. The author says, you are not what your balance sheet says. You are the person who learns every day and slowly becomes better. The biggest lesson of this chapter is that if you can train your mindset, you can reach a completely different level in trading. And for this, you need to identify emotions, control them, and follow daily rules. Only those who can conquer themselves survive in the market. Chapter 6. A Trading Plan. In the 6th chapter, the author talks about a topic that most traders ignore, and that is a trading plan. If swing trading is a war, then the trading plan is both your weapon and your shield. Trading without a plan is like shooting an arrow in the dark. It might hit the target, but most of the time it fails. A professional trader is one whose every step is backed by a solid logic, and that logic comes from his plan. The author first explains that a trading plan is not just about fixing entry and exit points. It is a disciplined guide that helps you make decisions and avoid specific situations. A good trading plan is like a professional athlete's workout routine, absolutely specific, regular, and emotionless. The first thing that should be in a strong trading plan is your trading style. That is, what kind of chart patterns or indicators you follow, whether you focus on breakouts or enter on retracements or trade based on moving average crossovers. This should be clearly written. Through this, you can recognize your own trading style and always focus on the same type of setups, which leads to consistent and specific results. Then comes entry and exit. That is, when and how you will enter the trade and when and how you will exit. The author suggests that there should be a confirmed signal before every entry, whether it comes from price action or an indicator. At the same time, the exit should happen for only 2 reasons. Either the target has been reached or the stop loss has been hit. Besides this, no third reason, such as fear, news, or rumors, should be a part of your decision.
Now, let's talk about position sizing. This is an aspect that most new traders ignore, and this is why one wrong trade sinks their entire capital. The author clearly says you should not risk more than 1 to 2% of your capital on any single trade, which means even if there is a loss in a trade, your trading account should not be destroyed. Fix the position size in such a way that the loss up to the stop loss is a very small part of your total capital. This will allow you to survive for a long time, even if some trades are wrong sometimes. Next comes the rule setting part. A professional trader creates some if-then rules for himself. For example, if the RSI rises above 30 and the volume is high, then buy. Or if a stock falls by more than 10% in the last 5 days and is at support, then wait. These rules save you from making emotional decisions and guide your thinking in a specific direction. The author also emphasizes that a trading plan is not just for writing, it is a living document that should be revised from time to time. It is also important to update the old plan as you gain new experience. Discard the things that repeatedly fail. Strengthen the things that consistently work. In addition, before creating a trading plan, you also have to look at your lifestyle and time availability. If you have a full-time job, then you need a setup that works on a closing basis so that you don't have to look at the chart repeatedly during the day. On the other hand, if you do full-time trading, then you can look at intraday or shorter swing setups. The trading plan should be compatible with your life. Your life should not have to adapt to it. The author gives a very important piece of advice. Don't confuse activity with progress. Many people take dozens of trades every day, but in reality, they're only busy, not productive. A strong trading plan saves you from such unnecessary haste. You stay focused and only look at those trades that fit your framework. The most powerful part of this chapter comes when the author says a simple thing. If you don't have a strategy, no logic, no rule-based system, then you are not trading, you are just testing your luck. And no one relies on luck in the market. In conclusion, the author suggests that you should create your trading plan concisely in a single-page document so that you can look at it once before every trade. It will include your setup, entry-exit criteria, risk management, and emotional guidance. This one-page plan can be your most powerful weapon, which will not only guide you in every trade, but will also help you make a cool-headed decision when you are in doubt. The 6th chapter teaches that it is easy to catch a trend, but to catch it at the right time, in the right quantity, and to leave it at the right time, all this is possible only when you have a strong, logical, and self-made trading plan. The market rewards those who come prepared for it.
Chapter 7. Trading Psychology. The 7th chapter talks about an aspect of swing trading that is probably the least discussed, but the most decisive force. This is trading psychology. This is the part that works outside the chart, but has the most impact on your trading results. The author says very clearly here, it is not difficult to beat the market. Controlling yourself is the real challenge. Trading is a mental game. The chart remains the same for everyone gets the news equally, and the indicators are also the same for everyone. The difference comes in the decisions, and those decisions come from your mental state. When you are afraid, you exit early. When greed takes over, you trade against the trend. And when you want to take revenge, you put all logic aside and take the next trade. The author says that the biggest difference between a professional trader and a new trader is not that the professional has more knowledge about the market, but that he can control his emotions better. Fear, greed, uncertainty, and frustration, these one by one take over the trader's decisions, and if they are not stopped, a good trader also slowly turns into a loser. First, let's talk about fear. This feeling often comes when the previous trade resulted in a loss. You hesitate to take the next trade, or even if you do, you exit early. This fear keeps you away from possibilities. The author says the only way to escape fear is to have faith. And this faith comes when you have repeatedly tested your plan, when you have data, and when you have confidence in your own system. The second feeling is greed. Many times when a trade continues in your favor, we start thinking, let's wait a little longer, maybe there will be more profit. Behind this is a hope, which is the most dangerous thing in trading. Maybe the market will turn around. Maybe the stop loss won't be hit. These kinds of thoughts prevent you from making rational decisions. Then comes revenge trading. When there are continuous losses, we try to make up for those losses. This is called revenge trading. This is not trading, it is gambling. The author says that every trade is a new opportunity, not a means to make up for old losses. Take the trade as a trade, not as a mental loss.
Now the question is how to control these emotions. The first way is journaling. The author repeatedly emphasizes that you should record every trade, why you took it, at what price you took it, why you exited, what was the result, and what was your mental state at that time. When you write a journal for a few weeks, you will start seeing the patterns yourself when you make wrong decisions emotionally. This journaling is your most trusted teacher, and it clearly reveals your weaknesses.